Nominal versus effective rates of return. Return on investments is the ratio of money gained or lost on an investment relative to the money invested. Economics Fisher puts forth the equation: nominal interest rates equals actual interest rate plus actual inflation rate. If the expected inflation rate is different from the actual inflation rate, the expected real rate of return will not be equal to the actual real rate of return. Even if there is a positive net nominal rate of return in the balance sheet, after taking inflation into account, the effective rate of return might still vary, enabling adolescents to understand the difficulties in making a real return. In another sense, the nominal rate of return is defined as the rate of interest stated on the financial tools, which effective rate of return reflects the effect of frequency of compounding on actual investment return. Knowing the fact that the more frequent interest is compounded, the larger the final amount will be, we should therefore always consider the effective rates of return than the nominal rate of return when comparing benefits. Preferred stocks, common stocks, and bonds. Both common means of raising capitals is shares and certificates of ownership, and bonds are certificates of debt. Stocks can be generally distinguished as common stocks, preferred stocks. Common stockholders of a company have the voting rights in important decisions made by the company at annual general meetings and selecting board of directors, but receiving dividends only when declared. Unlike common stockholders, preferred stockholders receive dividends at a fixed rate and in a higher priority, which tends to enable them to yield more dividends than common stockholders, but having limited rights. While preferred stock pays set dividends, bonds offers investors a regular interest payment. A corporate bond is debt security that a company issues and makes available to buyers. Bonds are redeemed on maturity dates, and the guaranteed interest enables investors to lower risk. If the company declares bankruptcy and undergoes liquidation, bondholders are of higher priority than shareholders upon payment. Present value and future value. By undergoing investments, a dollar received today can be worth more than in future through earning interest. The process of reinvesting interest into markets to make even more money is called compounding, so that we can predict the future of your capital. Conversely, through discounting, we can find how much money was originally needed to compound to the targeted amount in the future. That is, here to here. We travel back in time, which is the present value here. So how do we do the process of discounting? First, we can use the concept of present value to help us to make financial decisions. First, and it includes determine the cost of investment, estimate the total cash inflows from the investment, estimate the market value of the investment, calculate the present value and total net cash inflows, and market value of investments divided by its estimated interest rate, thus the total PV, the present value on the maturity date. At last, calculates the net present value, total PV at maturity date minus the initial cost at present. If the NPV is positive, it is considered worth investing.